Assalamualaikum warahmatullahi wabarakatuh. Hi everyone. We are from Group 12. We are here to present our materials about financing ongoing operations and tax planning. But first, I need to introduce you to my group members. First is me, Cindy Nabila Andri. And then next up we have Saul Lasri Rohayani Zakoto. Okay, so I will do my part from here. So firms can generate cash flows from a variety of sources to finance ongoing operations, including operating earnings like net income from sales of products or services, sales of operating assets such as plant and equipment, sales of investments such as stock, bonds, or raw land, short-term borrowing. Next is accelerating factoring or selling receivables, and then decrease in dividends. Next is payment of stock dividends instead of cash dividends. Next is stock buybacks by the firm or management to reduce dividend payouts. And so next is employee stock option plans or ESOPs. Next is receipts of dividends from subsidiaries, which is domestic and foreign. Each of these methods has tax implication that can be analyzed using the seven framework. Okay, next, we're talking about the operating earnings. So operating earnings is net income from continuing operations, excluding realized investment gains. Operating earnings after payment of federal, foreign, and state or local taxes will be added to retained earnings. And then earnings are retained without a legitimate business purpose may subject to a special penalty taxes, such as the U.S. accumulated earning tax. The workings of these penalty taxes are highly complex. The whole idea of this is actually really simple. The corporation should not use to hold a passive investment merely to take advantage of lower corporate marginal tax rates. And highly successful closely held corporations might have trouble if they accumulate large amount of liquid assets and do not routinely pay dividends. Should either of these situation occurs, it is wise to consult an expert in the area. Next. Next is sales of operating assets. Gain or losses on the sales of operating assets generally are taxable or tax deductible. Some gains may be tax deferred, particularly when the sale was voluntary due to the condemnation or all property was being traded for new. Some losses are non-deductible. There are limits on capital losses, passive activity losses, and losses between related parties. Capital gains are not taxed in many jurisdictions. In those where they are, capital gains usually are taxed at ordinary income rates unless offset by other capital losses. And losses on the sale of operating assets usually are treated as ordinary losses and are fully deductible. But note that depreciations previously taken reduce an asset's basis. This is generally the results in reducing the loss or increasing the gain if the asset is sold. Thus, the tax benefit of the depreciation flows from time value. Next. Next up, we have sales of investment. So investment are income tax favored throughout the world. In the United States, they usually are capital assets, generating capital gain or loss on sale. Such gains and losses are netted together for the year. If there is a net gain, it is taxed like any other income for corporate taxpayers, but at reduced rate for most individual taxpayers. Net losses, however, are non-deductible for corporate taxpayers and must be carried over. Like the net operating losses or NOLs, regular corporations that generates the net capital loss for a year applies the loss in a stylized way. First, the corporation's tax return for the year 3 years before. For example, year one for a loss in year four is reviewed. If the year were net capital gains for the year, the return would be restated and a tax refund calculated by offsetting these gains with the current year's loss. If this loss exceeds the capital gains, the excess is carried forward to the second previous years. And then this is repeated until the fifth year after the net loss. After the fifth subsequent year, any remaining carryover will be disappear. Otherwise, the same tax management also tax management principles of timing and as the same tax management principles of timing and negotiation that apply to operating assets also apply to investment. However, the sale of investment can have a very different impact on US firms' financial statements than the sale of operating assets. Under the US Generally Accepted Accounting Principles or GAAP, unrealized gains or losses on operating assets are not recognized, and thus their net book value remains at the appreciated historical cost. However, unrealized gain and losses on marketable securities are typically recognized under mark-to-market accounting. Thus, their book value often is much closer to the current market sales, and the gain or loss reported in financial statement in the year of sale minimal. Next, we're going into the examples. So here we have the examples. Suppose a firm has a blue chip stocks purchased in a year one for 10 million with this basis and fair market value. As per December 31, which is in the second year, the basis price of the stock is $10 million. Meanwhile, the market value of the stocks is $50 million. But as for December 31 on year three, the basis is still the same on $10 million. The market value reached the $75 billion. So if the firms sell the shares in year three, there will be a taxable gain of 75 million minus 10 billion, which is equals to 65 million. The gain is capital unless the firm is a dealer in securities, and unless there are some unused capital losses to offset against it, the gain will be taxed like ordinary income. But if the firm is in the 35% bracket, there will be 22,750,000 of tax due. If the firm is in a no carry forward status, no taxes will be due. If the firm tax in marketable securities, for example, it had an active business buying and selling securities, and it had elected mark-to-market accounting, there will be a little tax due on the sale. Under this method, the firm would have recognized $50 million minus $10 million, which is equals to 50 million gain in year three and paid tax of 14 million. In year two, the only 25 millions of appreciations occurring that year will be taxable. The tax for year two would be $8,750,000. So the total tax, which is not discounted for the time value, would be the same as in the previous paragraph, which is 22,750,000. Next, we're going into the short-term borrowing. So cash flow from borrowing are not taxable. However, subsequent interest payment on the debt normally are tax deductible. Interest payment on short-term debt, such as bank notes, are usually higher than those on long-term debts. Firm may favor such junior debts because typically it does not violate debts covenant into on existing long-term financing. Transaction costs include loan fees, which must be capitalized and amortized over the term of the loan. Next. Next, we have account receivable. So cash can be generated from customer receivables in a number of ways. Offering discount for early payment may affect the timing of cash flow, but the timing of taxable income recognition is usually unaffected. This is because taxable income is already recognized under the accrual method of most firms. So selling and factoring of accounts receivable result in recognizing a tax loss if the firm has already accrued the sales revenue for the entire sale. This has happened because the buyer or this case is factoring institution pay less than the actual receivable amount. Also, the impact of bad debt should be mentioned at this point. For financial accounting purposes, bad debts usually are expense based on expectation. For example, the firm may have historically had a 5% of credit sales that become uncollectible. So it will accrue a bad debt expense of 5% of each year's sales. However, for US tax purposes, bad debts are written off only as they actually go bad. The write-off can occur only when the debt becomes worthless and not when the firm give up attempting to collect, because it may take years for some loans to become worthless. The present value of the tax deduction can be dismissed. Next. Next up, we have decrease in dividends. Firms can increase internal cash flows by decreasing dividend payments to shareholders. All other things being equal, shareholders should not mind a lack of dividends, as long as the firm can invest the money and receive at least a greater return as the shareholder would have received when investing it. This is because stock's value should increase by the amount of the unpaid dividend plus any return on it. Furthermore, those shareholders who need current cash flow may be able to borrow against their shares or sell some of it. Shareholders also may reap a tax advantage from decreased dividends. Dividends are taxed when received. However, if retaining cash from reduced dividends increase a firm value, shareholders will recognize income only when the stock is sold. This is occur whether the stock is sold to a third party or redeemed by the corporation itself. Retaining cash from reduced dividends also creates a timing advantage because shareholders can choose when to recognize income by selling stock in favorable years or not at all, or maybe not at all. Because most institutional investors in U.S. capital markets are exempt from income taxes and tax advantages do not dominate the decision to pay dividends. There are significant non-tax reasons for paying dividends. However, prime among these is the concern that cutting dividend signals that be in firm anticipate previously unexpected financial difficulties in the near term. And when the dividends are paid to a non-tax exempt shareholder, such as an individual investor, there can be a double tax. Once the corporation when it has the earnings, and again to the shareholders when the dividend is distributed. Thus, the dividend preference of the firm shareholders may very well depend on their tax-paying status. Recognizing this difference, firms often divide shareholder groups into separate tax clientes. Next. Okay, next we have stock dividends. One option available to the firm to pay stock dividends is stock. Then the firm can retain cash and instead incur only the transaction cost of determining shareholders and printing additional shares. Stock splits are non-taxable so long that they are prorated. By providing a greater number of shares, existing shareholders can sell smaller portion of their holdings and per share purchasing ability is to enhance for both existing and new shareholders. Okay, next up we have stock buybacks. So if the redeem of its own shares, maybe in this case it purchases of treasury stock, it is generated as a negative cash flow in the short run. However, in years after the buyback, more cash can be retained because fewer dividends need to be paid. And there is an increase in value adding if earnings per share increase due to there being fewer shares outstanding. The buyback also has no tax consequences to the firm, but the shareholders usually recognize capital gain or loss on the difference between the redemption price and their tax basis in the shares. Next. Okay, for the next part, it will be presented by my friend Saur Lasri. Saur, time is yours.
Okay, thank you, Cindy. So in this section, we will see the using employee stock ownership plans or ESOPs. An ESOP is a firm-sponsored scheme where shares of the firm are owned through a fiduciary by the firm's employees. Dividends paid to the employee via the ESOP are deductible as compensation expense. If the firm borrow money to buy shares on the open market to be put into the ESOP, the interest expense is tax deductible as long as it doesn't exceed 25% of the compensation paid to employees. For example, here, suppose 40% of a US firm's $1 million shares are owned by its ESOP. The rest are owned throughout the market. If a dividend of $10 per share is declared and the firm is the 35% tax bracket, the after-tax cost to the firm is as this picture. So the firms will share to the ESOP for 400,000 shares times $10 times 1 minus 0.35, which equal to $2,600,000, and the cost is 6.5 per share. And for the shareholder, 600,000 shares times $10, which equal to $6 million or equal to $10 per share. From the previous example, without the ESOP, the after-tax cost of paying dividend equals its pre-tax cost, which is $10 times 1 million equals to $10 million. With the ESOP, the tax saving from deducting dividends to the ESOP reduces the after-tax cost of paying $10 million in dividends to $8,600,000. And then we came to the receipt of dividends from subsidiary. As in most jurisdiction in the United States, the payment of a dividend is a tax-neutral transaction to a subsidiary. It cannot take a tax deduction for dividends paid. For overseas subsidiaries, payment of a dividend instantly triggers income that had previously been deferred. There are two mechanisms soften the blow as follows. The first one, there is a dividend receipt deduction to that the income that generate the dividend was originally from US source. And the second one is there is also a credit for foreign income tax paid on the earnings being repatriated. As we can see, the foreign subsidiary will directly share the dividend fully taxable to US parent, and for domestic subsidiary it will be consists of some parts. There are 30% taxable to parent if under 20% ownership, and 20% taxable to parent if 20 till 79% of ownership, and non-taxable to parent if 80% or more ownership. So the U.S. income tax on dividends received from foreign subsidiary can be reduced by a foreign tax credit. The credit is based on the tax that were paid on the earnings that generate the dividend. The credit is the lesser of actual foreign tax paid or deemed paid or a set limit. The limit estimates the U.S. tax paid on the underlying income and is calculated as total U.S. tax times foreign source income and divided by worldwide income. The last section of this presentation is putting it all together, the financing ongoing operation from a seven perspective. The example here, a medium-sized corporation has a 10 million working capital need for the upcoming year. It can provide $6 million from its own operation and also must find $4 million from external sources. Management has put together this option, each of which can generate the $4 million. For simplicity, the firm would like to choose only one of these options. The first option is sale of marketable securities, where the securities have market book values of $6 million and they pay 12% per year on average. And the second option is short-term or 1 year bank borrowing at 10%. And the third option is sale of a warehouse where that is not being used to full capacity and inventory could be easily and costlessly held in other warehouse. The warehouse plus underlying land could be sold for $7 million and adjusted tax basis is $5 million. And the fourth factor is factoring some uncollected accounts receivable. There are $50 million in receivable. A factor specialist has offered to buy any of them at 50% of face value. And the last option is pay a dividend from one of its 70% owned subsidiary, where the subsidiary has $10 million in retained earnings. So to analyze this option, each of the proposal from a seven perspective, we can see such as follow. The first one, sale of marketable securities, where the net proceeds are $6 million and the taxable gain of $1 million is tax-free due to the net operational loss. Despite the tax advantage, there is an arbitrage disadvantage, which is the securities earn 12%, but borrowing costs are 10%. The net financial statement impact is $1 million gain, which consists of loss of 12% times $6 million, equals to $720,000 interest income, and net effect is $280,000 net income increase for the current year. And then short-term borrowing. Annual interest cost is $4 million times 10%, which equal to $400,000. This also is the reduction in financial earnings because there is no tax deduction with the NOL. Sale of warehouse, where the gain is $2 million, even with the tax of $2 million times 0.35, which is $700,000. There is still more than enough to cover the $4 million working capital needs. So the net effect on the financial is gain of $2 million. And the last one is stock dividends. There is no tax effect here as long as the split does not involve cash or non-pro rata distribution. There is no effect on the income statement either. Next is factoring accounts receivable. There is no current tax effect on the tax loss of 4 million times 50%, which is $2 million. The tax law simply adds to the NOL and will be used next year. Net effect on the financial, which is $2 million loss. And the last option is dividend from subsidiary. Even though 30% is subject to tax, the NOL absorbs the income, resulting in no tax. If the subsidiary is accounted for under the equity method of counting, there is no financial accounting income effect. So from this all, in summary, from a tax and financial accounting income perspective, the win-win choice looks like the sale of the warehouse. After this, there are other aspects of 7 bearing on the decision. The first is strategy. Since the warehouse is unused, this will not harm any strategic production plans. And for the anticipation, much of this has to do with the firm's transition out of NOL status. And the value adding, also some strategies might be viewed negatively by the firm's shareholders, especially the stock dividend. If so, the firm's stock price will drop, raising its cost of capital. In terms of transaction costs, sales of marketable securities will involve brokerage which is sales of the warehouse will involve real estate again commissions. And then negotiating. Under the sale of warehouse plan, this is directly not applicable. Under the stock dividend plan, the firm may have to offer something extra to shareholders to get them to accept no dividends. Under any plan that reduces financial earnings, management would have to be negotiated with to persuade them to take reduced bonus. And the last one from 7 perspective is transforming. Because of the firm's current NOL, any gain-generating transaction is tax-free. However, a plan that generates losses does not create a deduction that can be used. That's all. Back to Cindy.
Okay, so I think that is the end of our presentation. I hope you guys find it helpful to help understand a bit better about the material regarding the material. But if you guys have any questions about our presentation, or there's some things that you guys just still curious about, please do tell us, and then we will try our best to answer it. And I'm sorry if we made mistake here and there. That's it. We'll close this presentation. Assalamualaikum warahmatullahi wabarakatuh.